Hello and welcome. In today's video, I wanted to do a deep dive in what a reverse mortgage is and give you a brief comparison between a reverse mortgage and a home equity line of credit, and also give you a practical example of how reverse mortgage is making a significant difference in one of my clients' lives. And I didn't want it to be just academic where I just give you a definition, which is what I see in other YouTube views about what it takes in terms of qualifying. The starting point I think we should have is defining our terms between what a HECM is and what a HELOC is. So I put this together. A HECM, which is the name for the reverse mortgage, it's a home equity conversion mortgage, is different in concept and entirety than what a HELOC is, which is a home equity line of credit. What I want you to notice is that whether it's a HELOC or a HECM, they both deal with home equity, and they do it in a different way, so that with a reverse mortgage you have that equity converted back to the homeowner, because that's what a reverse mortgage is. Reverse mortgage gives the homeowner an option to convert a portion of their equity either into a line of credit, or if there's a balance on the house, to pay the existing balance and not have to make a mortgage payment, or if there's enough equity to pay the existing mortgage and even have a line of credit. The home equity piece for a HELOC, which is a line of credit, works in a different way. It's similar to a credit card idea, where the bank gives you a line of credit, and for a certain period of time, typically for the first 10 years, the homeowner is able to use this line of credit to draw on it and to make payments, typically interest only. And this back and forth with the line of credit is something that goes on for 10 years, and after that 10-year draw period is concluded, there's a 15-year repayment where the homeowner is now obligated to pay principal and interest payments and can't borrow from the line of credit anymore. If you have had mortgages up to this point in your life, you're familiar with the line of credit, because most likely if you've had your property for a significant period of time, 20, 30 years, through the good times where property values have appreciated, you've been offered a line of credit. And that line of credit was practically given to you or forced upon you for free, because the bank kept on telling you, well, the values are really high, you should have a line of credit, you could always use it, and it's a great idea to have it. And they gave it to you. What they don't tell you at the time that they give it to you is that, first of all, the bank reserves the option to freeze the line of credit, close the line of credit, or reduce the line of credit if they see that property values have significantly depreciated. I did a really extensive deep dive video about what home equity is, what home appreciation is, what home depreciation is, and how you really build equity. For the purposes of understanding where you gain equity and how you keep it, and how to take that equity that you have right now to benefit you off the table, I would encourage you to watch that video. But for the purposes of this conversation, one of the factors that I talk to seniors about is the line of credit that got you here is not going to help you get through the next 15 to 20 years of retirement, because it's not designed to do that. And the reason it's not designed to do that is the simple fact that when you're in retirement, you're dealing with several major changes of your life. Economically, you're no longer working, so you're not receiving employment income. Your income is limited because most likely you're getting, if you're lucky, a pension income and Social Security, or if you have significant investments or 401 or retirement account, you can draw from it. The line of credit, which is the HELOC, requires you to pay monthly payments on that line of credit. So if you've drawn up the line of credit and your interest only period has terminated, now you have 15 years to make principal and interest payments. So now you may have an existing mortgage and you also have a line of credit on top of it. So now you have to not only make a mortgage payment, you also have to make a line of credit payment. But you're no longer working, so your income is significantly reduced, and you're having to each month use your savings, your 401, your retirement account, as well as your Social Security and your pension if you have one, to pay down a line of credit and a mortgage. But meanwhile, your house has appreciated and you have a significant amount of equity. So you're not able to convert this equity, you're not able to access this equity. The reverse mortgage works in the opposite of what a line of credit is. The reverse mortgage recognizes that there's a significant amount of home appreciation, and you as a senior are concerned about two things: not running out of money and being able to have a guaranteed ability to age in place in your own home. So what the home equity doesn't allow is that safety and peace of mind, because if you can't pay on the line of credit or you can't pay the monthly mortgage payment, you're going to be in a situation where you could be in foreclosure. But with the reverse mortgage, that's taken off the table. You're guaranteed housing so you could age in place for the rest of your life and for the rest of your spouse's life. Now, the question becomes, there are some clients that have a property and it's been paid off and it's significant in value, but unless and until you get a mortgage against this property, how are you going to be able to tap into the portion of this housing appreciation? You can't. So some clients say to me, well, I could go get another HELOC, another line of credit. But then when they go apply, the bank tells them that they can't qualify because they can't make the monthly payments if they were to get a $200,000 line of credit, and they need to live on that line of credit because the monthly payment that it would be produced is greater than their monthly income because they no longer have employment income. So then the conversation becomes, what would a reverse mortgage do for that type of a client? And this is the example I'm going to share with you so you could have a visual and maybe put yourself in a position where you could say, how am I similar to this person, or how would what's helping him be able to help me? So we have a house. This represents the house. Our client, his name is Rodney. We're going to call him Rodney. And he's 73 years old. The property appraised at $725,000, and there's zero mortgage owed on the property. If Rodney wanted to go get a traditional line of credit or a mortgage, the bank wouldn't lend to him because he wouldn't qualify. And what Rodney's concerned about is being able to tap a portion of the equity of the house, but to also be able to age in place so that for the rest of his life he could stay in the house and use a portion of that money that he's getting in the line of credit to help him offset some of his expenses. Visually, what I wanted to show you is something that it makes a really, I think, big impact for my clients, and it takes it out of the realm of just conversation. So you need to have an active imagination for the next couple of minutes and understand that what we're talking about is we appraised a property, and here's $725 in stacks of $100, and we're going to say that the $725 represents $725,000, which is what the property appraised at. So what we tell Rodney is, we're going to make available to you $346,000. So this is the $346,000, that's the line of credit. Now Rodney says, look, I don't need this money right now, and I don't want to have to make a payment on it. So we tell him, look, as long as you're not using the line of credit, it's just available and it's going to stay in place, and when you need it, it'll be there. What's the benefit of this? What's the benefit of this, and why are we encouraging him to do it now? Well, we're encouraging him to do it now because we said there's 3 criteria for determining what the loan amount is in getting a reverse mortgage. There's the age of the borrower, there's the interest rate of the program, whether it's a fixed reverse mortgage or an adjustable reverse mortgage, and the property appraisal. Right now in California, January 2022, property values are through the roof. Rodney's property appraised at $725,000. And we put this money, the line of credit money, aside for him. So should something happen where the next 2 years or 3 years, property values go down, let's say they go down $200,000. Now the property is worth less. The bank will never come to Rodney and say, because the property values have gone down, we need to either reduce or close or freeze your line of credit. Because reverse mortgages have protections and guarantees through FHA and HUD that will not allow for that to happen. That's a portion of the money that you're paying in getting a reverse mortgage, which is the insurance. It's the mortgage insurance premium. That's not the case with a line of credit. In other words, if you have a line of credit right now and your line of credit is for $200,000, and you say to me, well, my line of credit is for $200,000 and that's available to me right now, and I'm depending on that to help me get through for the next 15, 20 years. Chances are you're either forgetting or you didn't have a line of credit back in 2008, 2009, all the way up to 2012. Because all my clients who had lines of credit, the majority of them were getting either having to validate and prove they have significant financial ability to keep the line of credit, or they were getting letters that says that their line of credit was being reduced or frozen or closed. And my point to you is that at this point in your life, you cannot assume the financial risk of what happens if there's a significant housing downturn. And a reverse mortgage takes that off the table. So when we know the property is appraised at $725,000 and we get Rodney a line of credit, we're taking his portion of equity off the table, so it's not up for risk. We're making him risk averse. Now, what else are we doing? We're saying to Rodney, this money, when you need it, it'll be there for you so you could use it as you use it. So let's say, for example, Rodney takes $100,000 and uses the $100,000 for his living expenses, for his cares, for his nursing, whatever the situation is, okay? And Rodney decides that he's either going to move to a different house or, God forbid, he passes away. One of the concerns that a lot of people have when getting a reverse mortgage is that they think that they automatically lose all this equity in the property. And that's not the case. The determination of how the equity is used really has to depend on your starting balance on your house. In this situation, we know Rodney had the property paid off and there was no mortgage on it. And if he's only used $100,000, either when he sells the property or when his estate sells the property, all of this equity is still existing. So when he or his estate sell the property, they look at what they owe the bank, and they owe the bank $100,000. Just like any other kind of a mortgage that you would have gone through, the bank gets paid the $100,000. The balance of the money that's left is the estate money or the client's money. Now, another scenario that people talk about that I wanted to kind of go over is, well, Benny, I don't owe the property free and clear, and you're telling me I could get $346,000. Let's say this was an example where Rodney had $200,000 owed to the bank. We would pay the $200,000 to the bank, And in his case, he would still have a $146,000 line of credit. That line of credit would be there for him just like it was before, but now there was a balance that started on the mortgage, which was the $200,000. For the purposes of this example, I'm not going to get into the cost of the program. I'm going to do a separate video because really the cost conversation has to do primarily with the most significant price point, which is the private mortgage insurance, and that requires its own separate video because there's a lot of features and benefits that it offers. And for this purpose, I just wanted to kind of give you as a broad picture of not only what it takes to qualify, but why you would want to get a reverse mortgage if you're in retirement now, compared to thinking that I'm going to get a line of credit, or I'm going to keep my line of credit, and my line of credit is going to take care of me. It really is not. So what I would encourage you to do at this point is you have to look at your monthly income, and you have to look at the amount of savings that you have and how much that savings generate. Because if you have a mortgage and you have a line of credit, or you have either one, or you have both, you have to look at the fact that your mortgage and your line of credit, the monthly payment that they generate, is competing for the income that you are getting every month, whether through Social Security, whether through a pension, whether through your 401 investments or your retirement account. And my question to you is, when I sit down with the clients, we go through a deep financial analysis. There's like about a 15-page financial analysis that I sit down and I go through with my clients. And it's very detailed. And it's not to be intrusive and pry into where you spend your money and how much you spend every month. It's really intended to help you understand that your monthly expenses, both for mortgage and for living, are a lot more than what you initially think. And then if we identify exactly what your sources of income are and how much your income is and what percentage of that income is being allocated to your housing, then there's two questions that I ask. Number one is, if you have such a significant amount of equity built into your house, why would you want to reduce it any further at the risk of running out of money, or at the risk of reducing the quality of life? And number two, which a lot of people don't really consider, is this, and maybe this is another visual that could really help you. Let's say you have a $100,000 mortgage right now, and you say to me, Benny, my desire is to pay off this $100,000 mortgage so that I could give my kids the house as an inheritance, or I have a house free and clear. My question then to you becomes, if this mortgage is $100,000, depending on how long ago you got the mortgage and how much money it requires to be paid, you're not really paying off a $100,000 mortgage. You have a $100,000 balance, but the concept of mortgage payments include principal and interest. So every month when you take money out of your savings account and you're paying a $100,000 mortgage, unless you're paying all of it in terms of you've had the mortgage long enough where it's all principal reduction, there's a lot of interest in every payment that you're paying. So you may be in a situation that in order to pay off a $100,000 mortgage, you end up having to pay $150,000 of principal and interest. And the other flip side of that conversation becomes is, do you have that much significant savings, whether it's your 401 or your IRA or something like that, to be able to pay off this existing balance? And even if you did and you paid off the property, what are you getting in return for it? Well, okay, I have the property paid off and it's free and clear. Great, congratulations. But your property is not liquid unless you sell the property and unless you go get another mortgage against it, you're not able to access any portion of the equity. And where's the benefit of that? A reverse mortgage will automatically guarantee you to be able to live in the house for the rest of your life and the rest of your spouse's life without having to make a mortgage payment. Why are you taking on this additional burden of paying down and paying off a mortgage when that money that you have is limited, your income is limited, your savings is limited, and you have all of this equity? So that usually starts the client to start considering other scenarios that they just hadn't been fully aware of, and thinking of it in a different way. I hope this conversation was able to kind of give you a broad picture, but really the starting place for us to be able to help you is to look at your specific situation. Do you have an existing balance on your mortgage? Is the property free and clear? Are you concerned about outlasting and outliving the amount of savings that you have? What would the numbers look like for you if we paid off your mortgage or made a line of credit available for you? Are you in a position where you could sustain the risk of another real estate market crash that could take 10 years for it to come back? If you're interested in finding out more, but with regard to a specific situation, I'd love to get a chance to have a conversation with you. I'm a licensed reverse mortgage specialist. I work exclusively with seniors to assist them with their retirement and with reverse mortgages. It's a passion of mine to be able to do this at this point, and I hope I have the pleasure and the opportunity to assist you. Thank you for your time. I appreciate your attention and look forward to speaking with you in the next video. God bless you. Thank you.